Thank you. Thank you, everyone. Thank you so much for all of you for coming, and it's such a pleasure to be able to be part of this event. Thank you to El Confidencial, thank you to Nacho, thank you to the Deputy Governor who I think just gave a very powerful, very relevant speech. Actually feeds into a lot of the themes that we're thinking about at PIMCO over the course of this year. So, and also just thanks to all of you for coming and being part of this. It is exciting to be here in Madrid at the beginning of the year to speak about the year that we're seeing, a year of convulso, as we say in the title here, and that I think is going to be a theme that we'll be hearing about over the course of today. We're titling this presentation here, Navigating the Descent. And what do we mean by that? The descent. Which descent? Descent of what? Descent of markets? Descent of politics into populism? Maybe. But especially what we mean here is the descent of interest rates, as we expect, along with much of the rest of the market, that policy rates across the developed economies will decline this year. So there will be a descent, there will be this decline in interest rates. But the question, of course, will be by how much, when, at what pace, with what uncertainties, and to what extent will there be convulso in this year ahead. We turn to the next page here and we show just how far things have come in interest rates. Here we show the 10-year US Treasury rate, and it has not been since well back in the early 2000s, 2006, 2007, 16 years ago or more, that we saw the US 10-year at or above 5%. But we did get there briefly, but we did get there last year, a very sharp rise in interest rates over the course of the last few years, a very difficult time for markets. We all can think back to 2022 and what a very difficult time that was in equity markets, in fixed income markets, in alternatives markets, etc. 2023 was supposed to be a much different year. If you think a year ago, this time last year, and I think it's a cautionary tale, this time last year, the market was kind of saying many of the same things that it's saying now. This time last year, the market was saying that inflation is under control, inflation is coming down, central banks see that inflation is coming down, and central banks will be able to cut rates. This time last year, the market was pricing in a very high probability that the Fed would be cutting rates in September of 2023. Well, we all know how that went. Last year was definitely a year of convulso. We had just a couple months later, after January of 2023, we had the decline and fall of the regional banks. We had the fall of Credit Suisse. We had a number of surprises on the inflationary front. And rather than the Fed cutting rates, the Fed raised rates and has kept on hold since then. So we just see how much the market can get a little bit confident and maybe even overly confident. We saw that last year. And so the question this year is, are we doing this again? Are we yet again overly confident about the pace of rate cuts and the path of disinflation? So turning to this slide, this is the most important chart in the world. And it's a boring one, it's about inflation. But it is the most important chart. The most important chart in the world is not about the Trump's popularity or Trump versus Biden. The most important chart in the world is not about the Chinese economy or even the path of economies in general. The most important chart in the world is about inflation. It all comes back to inflation. I'm looking forward to hearing the panel on geopolitics that will come after this, but I do think we need to realize that ultimately so much of what we're seeing on the political front comes back to inflation, comes back to the popular pushback to inflation. And look at what we've seen in some of the political trends, high inflation in Europe, and you get populism in Italy, a populist leader in the Netherlands, very high inflation in Argentina, and we get a very populist leader there, high inflation in the US, driving a renewed surge in populism in the US. Again, it all comes back to inflation. Of course, what's going on in the markets is all about the central banks, but the central banks in turn are focusing on inflation. Now, so let's spend a little bit of time on this chart. Certainly if we look on the left-hand side, it seems like things are fine. This is headline inflation. Headline inflation did overshoot, of course, has come back down aggressively. But much of the 2023 decline in headline inflation was about energy prices, a reversion to more normal conditions in energy markets, a reversion to more normal conditions in agricultural food prices, etc. So much of that is done. So what the real question is about core inflation. And on that front, there are some real questions. And on that front, I'd say PIMCO is probably a little less optimistic than the rest of the market, and it drives our tone of caution as we look ahead at the year of 2024 and as we look ahead at what we think could be this convulso. And probably, what you'll see here is that, yes, from very high levels, core inflation on the right hand of the slide, core inflation has come down, and that has been important. But if you look a little bit at the red line, we show the United States here, that red line has begun to flatline. That red line has stopped declining. And if we look at the last 6 months of core CPI in the United States, annualizing that 6 months, the last 6 months, it's been about 3.2%. The last 3 months, annualizing the last 3 months, have been about 3.2%. So there is this stickiness in core inflation that is emerging in the United States. It's not at alarming levels. 3%, 3.2% core inflation are not alarmingly high, but the Fed has a very strong target of 2%. Now, yes, that's a 2% target on PCE, which is a different inflation index than we're showing here, core CPI, but they're very closely related. PCE is usually about 25 basis points below core CPI. So if core CPI is coming in around 3 to 3.25%, that means that the Fed's PCE is coming around 2.75 to 3%, still well above target. So the question is, for how much longer is core inflation going to be sticky? So we need to drill down a little bit into where is the stickiness coming from. It's coming from, very interestingly and very surprisingly, the housing market. The housing market is one of the most concerning indicators out there in the United States right now, if you're looking at inflation and if you're looking at how the Fed is going to react. The housing market, if you go back to 2022, responded as you would have expected a housing market to respond when mortgage rates went from 3% to 7.5%, 8%. The housing market shut down. New starts, new home building in the United States collapsed. Mortgage applications collapsed. Home sales of existing homes collapsed. House prices in 2022 fell. And that's as you would have expected. And the Fed at that point was saying, all right, this makes sense. And this shows that over time, high policy rates will drive a cooling in the economy and ultimately a cooling in inflation. But 2023 was the surprise in the housing market. 2023 showed things stabilize and then starting to turn around in the housing market. And of course, with unemployment rates being so low, there's some cohort of people out there who need to buy a home. Yes, 7% mortgage rate, 7.5% mortgage rate is very high. But if you need to buy a home and you've got a job, you're confident about your job, your wages are increasing at 4 or 5% or so, making you think that maybe you can afford that 7.5% mortgage rate, then you started to see people coming back into the market and buy even in a tight mortgage market. And what happened in 2023 is that house prices started to stabilize and then started to rise. And over the last 6 months, house prices have been rising about 1% per month, every month over the last 6 months. And that looks to continue over the course of this year. A strong economy, despite high mortgage rates, is supporting this housing market. This is complicating things for the Fed because house prices appreciating drive rent prices going higher, which supports core inflation. Meanwhile, of course, you have a very tight labor market in the US. And I'm talking a lot about the US here, but it's very representative of the rest of the developed economies. You've got this tight labor market that also means it's very difficult to find workers in service sectors. So things like entertainment, education, healthcare, etc. Very tight labor markets driving core service inflation as well. So you're seeing this stickiness in inflation. Again, not at alarming levels, but at levels that really do complicate things for the Fed at a time when the market doesn't see any complications. What's so interesting is, here we are with this discussion of 2024 convulso, this discussion of problems and potential volatility, and yet if you look at the market is saying, no, there won't be any volatility. The market is saying things will be just fine. The Goldilocks scenario of not too hot, not too cold, everything is going to be okay. So what we show here in this slide is, if you look at historical episodes of Fed tightening, Fed loosening interest rates, whether in recessionary environments or in non-recessionary environments, kind of what the path would be. And the red line at the bottom shows where we would expect the Fed to be going in a recessionary environment. Of course, in a recession, the Fed would be worried about employment and the economy in general and would be cutting rates aggressively. In a non-recessionary environment, but assuming some disinflation, you get more the green line of the Fed cutting rates, but more slowly in an environment where the economy is okay, but inflation is coming down. Well, the market, pricing out what is going to happen with policy rates over the next few years, the market is saying not only are things going to be fine, they're going to be the best ever. I mean, essentially the market is saying things are going to be the best ever, that the Fed is going to have things perfect, where there's not going to be a recession, there's not going to be a renewal in inflation, there's not going to be serious disappointments on the inflationary front, and you get a continued decline in rates along the top of this green line. Now, that leaves markets, it's easy to say, complacent. It leaves markets vulnerable to disruption. It is not PIMCO's call that there will be a major disruption. It is not PIMCO's call that there is going to be anything thoroughly disruptive. But the problem is that we start from conditions that are essentially priced to perfection, with the market pricing in a Fed more or less completely in control of conditions and able to engineer a miraculous disinflation and a miraculous decline in policy rates, and that shows in some things in markets. So here what we show is, on the one hand, yields are very high. Yields are very high. We're looking at here over the last 10 years, where are current conditions relative to the last 10 years as a percentile basis. So if you look at US core yields, global yields, including Europe, Australia, etc., they're at around the 90th percentile of yields. This is as of the end of December, and actually yields have picked back up a bit over the last few weeks, so actually a little bit more than the 90th percentile right now. So yields, the starting rate on just the level of yields is quite high. But interestingly, if we dig under that, there's significant dispersion in markets in terms of where they are today relative to the last 10 years. If we look at the bottom part of the chart, here, high yield, investment grade, here the market is pricing in this perfection. Pricing in that the Fed will be able, and the ECB will be able to cut rates in an environment where there won't be a recession, maybe a little bit of economic weakness in Europe, of course, as we're seeing, but nothing too alarming there. And because you get this Goldilocks environment of rates coming down, not too much inflation, not a recession, the market is pricing in spreads in high yield markets at their 25th percentile. So over the last 10 years, spreads have been higher than where they are right now, 75% of the time. So the market very bulled up on high yield, on corporate credit in general, IG a little bit higher, but also not too high. On the other hand, you see markets that are still quite cheap. And this is one of our messages at PIMCO, is to look for those markets that remain dislocated but are not particularly exposed to a recession. This is our message, which is to find ways to recession-proof your portfolio. And there are still ways to do so. In the middle of this chart here, we show AAA securitized, so structured credit. This would be residential mortgage-backed securitizations. This would be consumer credit-backed securitizations, auto loans, et cetera, et cetera. But the AAA part, so where you're really not worried about credit conditions, you're not really worried about impairment, what you're worried about is liquidity. There, conditions are still dislocated. Also, agency mortgage-backed securities. So these would be the very high-quality securitizations from Fannie, Freddie, Ginnie Mae, backed by the US government, there too, spreads are very high relative to their long-term historical ranges. And that's because of the quantitative tightening that we're seeing in markets, particularly in the Fed, also from the ECB, where there still remain illiquid conditions in markets that keep these spreads higher. So you are able to find ways to capture interesting returns in markets without having to buy into the full thesis that everything is going to be just fine and rates will come down as inflation comes down. Turning ahead here, what do we expect for returns in fixed income? Essentially, returns in fixed income are going to be what yields are right now, and yields are high. That's the good news. If we go back over the last many decades, what we see is that over the next 5 years, your returns in fixed income are going to be essentially the current yields in fixed income. So if you look at yields today, what will be your returns over the next 5 years? Probably about what those yields are. So call it around 5%, a little less than 5% are going to be the returns in fixed income. That's a phenomenal place to be after fixed income returns have been in the low double digits for so long, negative, of course, in 2022. Here we expect that returns will be positive and quite positive relative to the last 15 years or so of history over the next 5 years. So we are able, we think, to capture interesting returns in fixed income. The question is, how do you express that? How do you express that, especially with an eye on the volatility that could come and the disappointments that could come if inflation does remain sticky over the course of this year, if the Fed is not able to cut rates as aggressively as is expected. And here we kind of pull together the themes, the key themes that we are looking at over the course of 2024 for us. First and foremost is that bonds now present diversification power. And that really hasn't been the case for very long. So over the long-term history, over the last many decades, the thesis around bonds is that they diversify your portfolio. When equity prices are falling, the theory goes, then bond prices are rising because equity prices fall when the economy is weak. When the economy is weak, central banks are cutting rates, and so bond prices rise. That has been the theory. Of course, when bond yields are zero, they don't really have very much far to go. And if equity prices fall, bond yields just sit there and don't do anything in the portfolio. Or when everything is going bad in 2022, when the central bank is raising rates, equity prices are falling, bond prices are also falling, there isn't that diversification benefit. Here, on the forward-looking basis, we at PIMCO strongly believe that we will see a resurgence, a renewal, a rebirth in diversification of bonds because we start at much higher yield levels. The 10-year Treasury north of 4% now gives a lot of room for decline in interest rates, a decline in bond yields, a rise in bond prices if we do see economic weakness and if we do see equity prices starting to fall. Certainly in the very short term, if there were a decline in equity prices, it would probably be not because of the economy, but because of inflation. And so, in the very short term, maybe we won't see all of that diversification benefit, because if there are going to be negative surprises over the next few months, over the rest of this year, it's going to be on the inflation front. And if there are negative surprises on the inflation front, there are going to be negative surprises as well with central banks, with the market pricing in a very aggressive Fed, about 150 basis points of rate cuts this year. Also, the market pricing in an aggressive ECB, Bank of England, etc. If we do get negative surprises on inflation, we'll get negative surprises on central banks, and then we probably would see a rise in interest rates, not a decline in interest rates. But our thesis would be that ultimately you would see a stabilization, and on a long-term basis, over the next few years, you would see that power of diversification come back. Then the other thing we would say is, do not wait. Lock in high yields now. Many of our clients, presumably a lot of people in this room, are very overweight cash. And it's easy to be overweight cash right now because cash delivers a lot of returns. In the Eurozone, high 3s, 4% in cash. In the US, mid 5s in cash. Those are really interesting returns, and you're sitting there clipping that coupon every year. It's quite powerful. It's quite comfortable place to be. But ultimately, inflation will come down. Whether it comes down sooner or later, it will come down. Whether it comes down because the Fed is able to cut rates sooner or later, it will come down. Ultimately, as inflation comes down, bond prices will rise, and cash yields will decline, and you will be kicking yourself for not having extended out into duration, extended out into more intermediate parts of interest rate curves. Another thing we would say is focus on credit quality. Yes, the market is pricing in a very Goldilocks scenario of no recession, of interest rates coming down, of inflation coming down, and that may well be the case. That may well be the base case, the most probable scenario. But there are so many things that could go wrong with that scenario. The panel will be talking about geopolitical risks and geopolitical potential shocks out there. Certainly there are potential disappointments on inflation, on central banks, etc. If those surprises do happen, you want to have, as we've said, recession-proofed your portfolio, be ready and resilient in the case of those shocks. And so focus on credit quality. Go into higher quality parts of credit markets. Again, those AAA structured credit parts of markets and or agency mortgage-backed securities. We also showed emerging markets. Emerging markets have come a long way in terms of their fundamental credit quality and yet are still offering reasonably interesting yields. So there are ways to diversify that portfolio. And the last thing we would say is probably something where we at PIMCO are a little bit biased. And we at PIMCO are the world's largest active manager of fixed income portfolios. Active meaning not passive. Active meaning we are actively adjusting portfolio positioning as we see things out into the markets. What we would say is that this is really a renewed golden era for active fixed income investing. When there is no volatility out there, when rates are zero or negative, nothing is happening, the Fed and the ECB are suppressing volatility, it is difficult to generate alpha. It is difficult to generate excess returns in active management because nothing's going on. And you can't really do much when nothing's going on. When there is a lot of uncertainty, when there is a lot of volatility in rates markets because of all of these consequential questions about inflation, about the path of interest rates, then you really do realize that there is opportunity for alpha, there is opportunity for excess returns through active management. So yes, we are a little bit biased, we would say, with respect to that, but we do see it as a great opportunity. And then another opportunity, and I won't go too much into this because it does become a little bit of a detailed conversation, maybe for another panel, but is the opportunity in alternatives. And this ties right back to the presentation that we just saw from the Deputy Governor, which I thought was an excellent presentation, and really spoke to a lot of the themes that we're seeing driving the rise in alternatives. It's the deleveraging of the banking system. The Deputy Governor talked about the decline in the active deployment into credit markets from banks, a prudent action from banks, really guarding their capital, guarding their liquidity. Also at the same time, a lot of this is all leading to deleveraging in the system. Households in particular, as the Deputy Governor mentioned, deleveraging quite a bit, not just in Spain, but globally we're seeing this as a trend. This is all creating opportunities for non-bank lending opportunities, particularly asset managers getting in there, playing the role that banks used to play in providing some of this credit to small and medium-sized enterprises, to households, to larger businesses, et cetera, et cetera. So this is a great secular theme for us. It will be an interesting opportunity. It is an interesting opportunity in 2024, but it will continue to be that over the course of the next few years. With that, I'll say thank you, and I'm going to take some questions from my colleague, Juanma. Thanks, Juanma.
Muchas gracias, Cristian. La idea de la parte de preguntas y respuestas era profundizar un poco sobre tu presentación, sí, pero yo creo que lo has contado prácticamente todo.
¿Todo?
Todo. ¿Te parece si intentamos un poquito en español?
Pues sí, está bien.
Perfecto.
Claro que no. claro que sí.
Estaba tomando notas poco a poco. Estaba tomando notas y decías que el gráfico más importante es sobre inflación.
Sí.
Y mi primera pregunta sería sobre inflación y su impacto en los bancos centrales, en la política de los bancos centrales. Todo el mundo habla de bajadas de tipos,
Sí.
pero ¿podría pasar lo contrario? ¿Podría haber una subida de tipo? Y dicho esto, ¿cuándo preemos nosotros en PIMCO que vayamos a bajar los tipos de interés?
Pues sí, pues todo es posible, ¿no? Pero una subida es muy improbable, creemos. Sí. Es posible si hay sorpresas en inflación, pero ¿cómo es posible? En Europa la economía es muy débil, en China es muy débil y China es muy importante con la inflación global ahorita, porque en China los precios están bajando y con precios bajando en China están exportando su deflación. Y con eso es muy importante, it's an anchor, no sé la palabra de anchor,
Sí, anchor.
sí, exacto, para inflación. So I would just say that a rise in inflation is improbable. But it certainly is possible, and we need to keep an eye out on that. And that's part of why we talked about, keeping your portfolio recession-proof, because it is certainly possible that there would be some real shock, and we'll hear on the geopolitical. And I think if there's going to be a rise in rates, it would be because of a very serious geopolitical shock that would again tighten conditions in the flow of goods. And certainly what's happening in the Red Sea is not very encouraging. So it's improbable, we would say, a rise in interest rates, but it certainly is possible, which is why portfolios really need to be ready for that kind of a shock. And you need duration in portfolio. You need to extend out into intermediate to long part of interest rate curves. Cash is not going to do it. You're not going to lose money in cash, but cash is not going to be a diversifier in the portfolio that rises when equity prices are falling on a shock like that. So it is our strong conviction that we do need to get ready for any of those shocks that might come. Now, the other question from Juanma was, ¿cuándo? ¿Cuándo van a bajar los tipos de interés? Pues en el verano is what we're saying. Yes. So, we do think that it's summer. Then people say, well, when in summer? Is it going to be, June or July, right? Actually, it's pretty interesting. So first of all, we don't think that the Fed cuts rates in March. And that, just a few weeks ago, the market was saying PIMCO is utterly wrong. There's a 100% chance that the Fed is going to be cutting rates in March, and also the ECB will start to cut earlier than expected. And then what we saw over the last few weeks was, especially from the ECB, a number of commentators from the ECB began to say, whoa, the market is getting overly excited about us cutting rates. We're not done yet on inflation. We probably won't start to cut rates until the summer. And then just last week, Lagarde at Davos was talking about the summer for cuts in rates at the ECB. And that's at the ECB where actually the economy is even weaker and there should be even more confidence about inflationary conditions. And so if the ECB is waiting that long, then you could imagine for the Fed, things are quite similar. So the market just a few weeks ago was saying 100% chance of the Fed cutting rates in March. Now the market has been backing that down. Now the market is pricing in about a 40% chance of the Fed cutting rates in March. We think that the Fed is not going to cut rates in March. The conditions are not there. Core inflation remains quite sticky. Core inflation remains dangerous. I mean, again, not to be alarmist, but you need to get inflation down. Rich Clarida is our colleague at PIMCO. He's the former vice chair of the Fed, left the Fed about 18 months ago, rejoined PIMCO. He is adamant that the Fed remains committed to 2% target. Now, does it have to be 2.00000%? No. It could be 2.1, 2.2, maybe 2.3% on PCE, but we're not there yet. That's the message. We need to get there. Yes, the Fed can start to cut rates from a very high level of 5.25 to 5.5%. The Fed can start to cut rates before we get to 2.0%, yes, but it will do so slowly. It will do so tentatively. It will be in a data-dependent way. It is our view that the Fed will wait then until the middle of the year, probably the June meeting more or less. Probably even then the Fed will be a little hesitant and a little reluctant to cut. The problem, though, is the election. you can't cut right before or right after the election. That just smacks of being politically motivated. And so if you're going to start cutting, you either cut in the summer or you wait all the way into next year, and that's just too dangerous because rates are quite high, and real rates are high as well with inflation coming down. And the Fed doesn't want to keep real rates that high for that long and risk an accident. And so the Fed will probably need to get started in the summer. So no, we don't expect an increase in rates. The answer to cuándo is no sabemos, pero probably the summer.
We don't have much time for more questions, but one of the questions, and Margarita was alluding to that, is the commercial banks stepping out of the credit market. Which are the opportunities that we can see there?
So, this is one of the most interesting opportunities to all investors, certainly to asset managers like PIMCO. PIMCO is taking the lead in finding ways to provide credit to those borrowers that are not able to access credit from bank markets. Margarita, I think, it was a fantastic presentation that showed very clearly that banks are conservative, that banks are enjoying high net interest margins, but they are tightening credit conditions out there. And this is the best of all worlds for banks because they don't have to take a lot of credit risk. They can tighten credit conditions and still generate a lot of interesting returns, especially here in Spain. And I thought we saw that very clearly in Margarita's presentation. But that leaves an opening. That leaves an opening of good credit borrowers, households, small businesses, companies, and across different types of credit. It can be residential mortgages, it can be auto loans, it can be consumer credit, it can be equipment leases, it can be aviation finance, it can be even more esoteric areas of lending. And that's where PIMCO is very actively building out platforms to be able to replace the banks, essentially, to take the place of banks in lending to these borrowers who are unable to find credit from banks today. It's a complicated business. It takes a lot of people, of infrastructure, of systems, etc. But it is ultimately a very exciting opportunity for our clients to work with us to provide capital to these good borrowers. This is most apparent in the United States right now, where the banks are most aggressively pulling back, and where banks failed in First Republic and in Silicon Valley Bank. But we're also seeing it in Europe, particularly in Britain and Ireland, but it is emerging in the continent as well. The failure of Credit Suisse left a bit of an opening there. So we're seeing this happening, this role of asset managers working with their clients to raise funds to be able to replace the banks. It's most apparent and largest in what's called direct lending. So basically lending to mid-sized corporates usually owned by private equity sponsors. So direct lending has been, and many of you will have seen that as a big opportunity that has arisen over the last several years. But now what we're seeing is that it's spreading away from corporate lending into household lending, equipment finance, that types of things. That's probably the most exciting place to be deploying capital in 2024 and beyond.
Oh, thank you very much. Podríamos estar aquí hablando sobre economía horas, pero tenemos que dar paso.
Sí.
Tenemos que dar paso a la parte.
Ok, muchísimas gracias a todo y a el confidencial.
Muchas gracias. Un placer.
Thanks, Walma.